It's an absolute misconception. It is, in fact, an error to think that you're borrowing against the death benefit when practicing infinite banking. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our Myths, Mysteries, and Misconceptions series, we're going to be considering the misconception that is out there sometimes, and that's why I'm going to address it here now so I can share this evergreen piece of content with everyone who's vetting and researching this idea of becoming your own banker, of implementing the infinite banking concept as described in R. Nelson Nash's book, Becoming Your Own Banker, that when you're taking policy loans, that you are borrowing from or borrowing against the death benefit. It's wrong. Let's talk it through. So when you have a properly structured whole life policy with a mutual company that pays dividends as your entity for practicing privatized banking, you are paying premiums. The premium that you're paying into your whole life policy, your regular scheduled ongoing premiums, are buying you a guaranteed death benefit. They are also building you a cash value that you, and that's, I'm just naturally getting ready to say and give away the, so it's the cash value that's built up in a policy that is the liquid, the accessible, the usable pool of capital that you have access to. It is not the death benefit. So let me just jump right to it. You're not going to be paying $10,000 in premium, for example, and getting $500,000 death benefit and just be able to pay $10,000 one time to get access to $500,000. That's not how that works. This is whole life insurance. Yes, it's being structured for the purpose of privatizing banking in your life, but the entity is still whole life insurance. And whole life insurance has regular scheduled ongoing premiums that provide a guaranteed death benefit to beneficiaries. And also, when it's been structured the correct way with mutual companies that pay dividends, it can have a significant cash value. Now, here's the relationship. The premiums pay for everything in that contract. This whole life policy is a contract. The premiums pay for everything in that contract. When the insurance company offers you that policy, okay, and you own that policy, all of the responsibilities are on the insurance company to perform. It's a unilateral contract. You have decided on the premium amount. That was a number that you chose that you wanted to be able to pay. And there may be flexibility there, but that's not the particular focus of this misconception that we are addressing. And there are several other common misconceptions or myths or mysteries around infinite banking and whole life insurance that I would encourage you to check out on this particular series. But the part that I want to focus in on is the premiums are paid. The responsibilities of that contract are on the insurance company to perform that guaranteed death benefit, that cash value that they're giving you access to. So the pool of capital that you get access to is a loanable amount based on the cash value. It is not based on the death benefit amount. Now, I believe that everybody should have an appropriate amount of coverage, appropriate amount of protection, death benefit to render. And we are all going to graduate, as Nash would say. So that should be an appropriate number. But that is not the number. The death benefit amount is not the number that we leverage and that we access for banking. It's the cash value that is borrowed against. I'm being real particular in my language here for a reason. Whatever the cash value of a policy is the amount that may be borrowed against. So you would be taking, by taking a policy loan, you would be taking a loan from the companies, the insurance companies' general fund account. General fund. You're not borrowing from or against the death benefit. You're not even actually taking the cash value itself. You're leveraging it. You are borrowing against that net present day value of the whole life policy, which is the cash value amount. You get to leverage that amount. So let's say you had a cash value of $10,000 currently in a policy. You can leverage that amount, and you might not even be able to leverage the full $10,000. These are real conservative companies. So if you take a policy loan, they might already be anticipating holding on to a fraction for contingency purposes. I mean, these are really conservative, really profitable, very old insurance companies. All the insurance companies that I own policies with and that I write policies with, they are companies that have been around at least 100 years paying consecutive dividends. So not only have they been providing these cash values for policy loans and these death benefits, but they've even been paying dividends for well over 100 years. So they're really good at what they do. And if they're going to give you a policy loan, it's you leveraging the cash value that you have built up hitherto. And the policy loan is actually coming from the company's general fund account because they have to put the money to work somewhere. They have to put the money to work somewhere, whether that's with high-end tier 1 deals, with bonds or real estate, big corporative things, partnerships, whatever the case may be, that the typical person is not getting access to as individuals. But as the policy owner, we stand first in line in access to that net present day cash value of that future death benefit. We stand first in line to be able to take that money and put it to work. Then the insurance company does charge you an interest, whether it's a variable interest rate or a fixed interest rate. Be familiar with your contract. They charge an interest rate, and that doesn't bother us if we're implementing infinite banking because we're going to give a true market value of interest to our capital, to the policy loans that we're going to pay back, and it's going to be more than what the insurance company is going to be charging on that policy loan from their general fund account. And that extra interest that we would pay back by giving a true market value on the policy loans that we take to be an honest banker is going to be additional premium into that policy. It would go into the paid up additions rider. It's going to be extra premiums into that policy, which just grows and scales the policy, increases the death benefit, increases the cash value. So that's how a policy works. Those are the relationships between premium creating death benefit and cash value both. Cash value being the net present day representation of that future greater death benefit. And you are borrowing against, you are leveraging against the cash value of a policy when you're taking a policy loan. So you're not actually taking the cash value out. You're borrowing against that amount because you have a contract that says you can do so. You have a policy. The policy is a contract. You have a contract that says that you can do so. You can borrow against whatever that cash value amount is while still maintaining the death benefit. Now, if you were to pass while having an outstanding loan balance, the death benefit would be diminished by whatever amount of an outstanding policy loan plus interest that you have, but you're never borrowing against or borrowing from the death benefit. It's erroneous. It's wrong. Somehow folks are getting that conception, and I've even had one or two people end up on my calendar and just ask that one question of, well, can I pay a premium one time and borrow against $250,000, $500,000, $1 million death benefit? Can I get access to $500,000 by paying one premium one time? And the answer is no. No. So I hope that that's helpful in clearing up this misconception about death benefit, policy loans, and implementing infinite banking. If you'd like to have a conversation about what it could look like for you to implement the infinite banking concept into your household or your business or your investing, then don't hesitate to get in my calendar. You can find me at durhamtalents.com. This has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care.